With Staples Business Advantage, you get the benefit of thousands of experts.
Plus optimizations powered by the latest technological innovations.
1 + 1 =
2.
3.
Whatever. Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
G'day and welcome back to Shares for Beginners.
G'day, Phil.
I'm Phil Muscatello. I've got many interviews in the can ready for release which suddenly don't seem very relevant. As Warren Buffett said, Mr. Market is a kind of drunken psycho, and he's particularly florid at the moment. I've suspended normal transmission and will be instead focusing on current market conditions as they unfold. We'll do that until Mr. Market is safely restrained in a padded cell. So I've asked Rob Gilmour, my guest on the very first episode, to come back in and share his views as of today, Wednesday, March 18, just before the market opens. G'day, Rob.
G'day, Phil. How are you?
Good. So there's obviously a lot of noise at the moment, but today we're going to discuss what's going on and how to look a little bit beyond all that noise.
Look, that's right. I think it is important to try and look through the noise. And in order to do that, it's trying to get a good grip and understanding on what we're dealing with.
Yeah, so what are we dealing with? You've got some views there.
Really, there's probably three factors to what markets are trying to come to grips with and what we generally as a society are trying to come to grips with. And it started obviously with the health crisis and the outbreak of coronavirus in China. And markets were quite sanguine for a period of time while this was going on, and highly complacent. But the impact of the health crisis is real. We've seen a lot of headlines saying it's just like the flu, and for most people it will be. You know, the numbers are about 80%. It'll be just very mild. But the real thing and the real panic or concern here is the other 20%, where 10 to 15% will need higher levels of care, and then there's 5% that will need intensive care. And when you start to extrapolate those numbers off the back of a virus that can spread very, very quickly because of the long incubation period, and if you start to see numbers being infected in the millions, then that 10 to 15 and 5% starts to translate into some pretty serious numbers on the health system. So governments have responded as a result of that. A pandemic has been declared, and normally when you get a pandemic declared, the focus switches from containment to management. And I think a lot of people out there have underestimated what management of this is. Containment is obviously trying to lock it down and stop it spreading. Management in this scenario to protect the health system is also a degree of containment, but trying to slow it. And in order to do that, we don't have an immunity to something like this. It's prone to spread very quickly. So in effect, it feels like containment now that we're being told not to go to public events, potential restrictions coming through in terms of attending pubs and restaurants, and a real impact on our daily lives. So that health crisis has brought about an economic crisis. You start to get that translating into the broader economy when people don't spend money. And it has a real impact on business cash flow. We're seeing it in tourism. We've had the double hit from the bushfires, and this is far worse. So when you're getting the demand and the economy shutting down, you're having that impact on employment. That is recessionary.
Because it's real. It's so much fear, and you can tell from people that they're really feeling the anxiety.
Yeah, they are. And if you read the headlines, you've got to be very careful about reading the headlines, because what you read in the press, it's biased, it's there to sell papers, it's sensationalist. I think we've probably all been a little bit guilty of underestimating it, knowing now that it's hitting our shores and the severity of the lockdowns. It's definitely more than the flu, but ultimately it is still a temporary short to medium term shock to the economy that's going on, and we'll get through it stronger on the other side. There will be a rebound, and it'll probably be a fairly quick rebound as markets have reacted very, very quickly to what's been a shock. I say a shock, but it took a while for the markets to see it as a shock. But they've reacted very quickly to the downside, and equally when the recovery comes, I think it'll be fairly swift in the markets as well.
Are you old enough to remember the last recession that we had in Australia?
Not the last. I do remember Paul Keating saying the recession that we need to have. Mm-hmm. I was in London during the GFC So
so you saw there.
I saw a recession, and that's when I came back to Australia and thought, well, it's a bit of a bubble.
So
here
what's it like? Because in my Twitter feed, I've been talking to some younger people who are saying, "Does anyone know what a recession is like? Can you tell us what it's like?"
Well, I remember when Lehman Brothers collapsed, and there's basically people got their notice straight away, and they're walking out the door with their box and all their belongings. I remember
like instantaneously.
Yeah. And I remember a run on the Northern Rock Bank over in the UK, and people queuing at the door trying to get their savings out of a bank because they thought the bank was going to fail. I remember the impact that it had on housing in London, the rental market in London. Luckily, in the UK, there were a lot of people that had tracker mortgages, and their mortgages followed interest rates down, and some people actually had a negative mortgage. Quite a strange phenomenon. But no, the impact was widespread. It was widespread in Europe as well. Europe was pretty hard hit. And obviously it was tough in America. But in Australia, we managed to ride it out through our relationship with China and through a bit of luck.
Yeah.
But it was a very different environment in Australia when I came out compared to what we'd been seeing overseas.
I'm old enough to have gone through 3 recessions, I think, in my lifetime. But what I've been saying is in the last recession in 91, 92, that was when I started my recording studio business. I'd opened the doors as the recession was happening. I lost my major client just as the door was opened as well, but still managed to last for 11 years and thrived at many times in that period.
Yeah, and that's right. It's really, you've got to ride that, take the good times with the bad, and hopefully, the bad, in this scenario, it'll be short. We know the problem that we're dealing with. We know that it can be managed ultimately.
Yeah.
And life will get back to normal. We do know that. At the moment, it feels pretty horrible, but it is a transition, and there will be a recovery on the other side. Unfortunately, there's going to be a lot of damage that's done in the meantime, and that's a result of companies out there that are overextended, companies out there that are more susceptible to the drop in demand, and that's going to be an unfortunate
and
consequence.
ordinary people, like I was saying before about my daughter, suddenly she hasn't got any work. She works in event management. There's no work, and that's going to impact a lot of young people and a lot of people who are live from paycheck to paycheck.
Absolutely, and that permeates all through the economy. Unemployment is going to spike, and again, it will be temporary, but it will be hard. That obviously has an impact in a country where household debt's fairly high as well, or very high. And
we're seeing these huge gyrations in the market at the moment, and they are quite unusual in terms of the history and the share market.
We've probably seen the quickest onset of a bear market in history, and that is naturally causing a lot of concern and a lot of stress and panic selling. We're also seeing a lot of things in the system unwind, and it's being exacerbated by things like excessive leverage or debt.
Yep.
So as soon as markets go down, those in the market that have debts to cover have to sell. We're seeing broad-based selling as a result of exchange-traded funds. So when people pull their money out, everything gets sold, exacerbated further by some exchange-traded funds that are leveraged. So that exacerbates the falls. And we've also seen an oil crisis thrown in there as well.
Yeah, not forgetting the oil crisis, which we discussed in the last episode.
Yeah. So a black swan event being coronavirus, and the second black swan event being an oil crisis. Now, ordinarily, the oil price and what's going on would be capturing a lot of the financial market headlines, but the reality is that's a sideshow compared to what we're seeing on the streets and the economic consequences of the coronavirus.
Okay, so that's looking behind the reasons for what's going on at the moment. People listening to this program, what should they be thinking about in their own personal situation and their response to the way the markets are operating at the moment?
Most important thing in these times is you don't need to panic sell. You hold on and you ride it out. Hopefully you've got some...
But that's the main thing, isn't it? If you don't have to sell, don't sell right now.
Absolutely.
That's the main piece of advice, isn't it?
Look, that's one of the mistakes a lot of people made during the GFC.
Yep.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
Recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes, only algorithms.
Let Staples Business Advantage use today's latest innovations plus our team's experience to make furnishing an office space easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.
When they sold, they actually crystallized their loss. And when they sold, they thought, well, we'll sell now and we'll wait until the coast is clear and then I'll get back into the market. Well, the reality is if you're waiting until the coast is clear, the market's already gone.
Yep.
And that was quite clear in the GFC. So when you get to that point of peak fear and when things are so bad, then that's possibly your time to actually, it's uncomfortable, but to invest. Now, you'll never pick that. But if you're thinking about things from a long-term perspective and you're buying into this market because you can, and you've got that long-term view, then, okay, you might buy an asset and you've got to be looking for quality in this environment. You've got to be thinking good assets, good income, something that you really want in your portfolio for a long time. If you buy now and, okay, the market goes down another 20%, you've got to be prepared for that. But thinking, well, if I buy this now, I know in 5 or 10 years' time, this is going to be a great asset that I want in my portfolio. So
That you got at a great price.
You got it at a great price.
Yeah.
Now, you may not get it at the lowest price. That's the reality. But looking through that noise and being selective through this period of time and keeping that long-term view as an investor, not a speculator, is really important.
And this current crisis is different fundamentally to the GFC.
This is not a GFC, no. The GFC was a financial crisis, and the GFC unfolded very, very slowly as a result of this contagion within the financial system, brought about the American subprime collapse in mortgages over there, and gradually it infected the whole financial system. And you're talking about a scenario there where the 10 biggest banks in the world were insolvent, or they didn't know whether each other was insolvent. And so the banks didn't trust each other. And the banks wouldn't deal with each other because they didn't know the underlying exposures that a bank might have had. And then Bear Stearns collapsed, Lehman Brothers collapsed, and then that's where the central banks sort of realised, we better step in and stop this and back up our banks. And that unfolded over a much longer period of time. But we're not dealing with that now. What we're dealing with now is more of an economic crisis. It's a growth crisis. It's a demand shock brought about the health crisis. And this is a different approach. So here we're seeing companies under stress, not the banks. Now, at the moment, the banks are well capitalised, much, much, much stronger than when they were in the GFC. They have a lot of liquidity. So the issue is not the banks. The banks can continue functioning and loaning to the economy. Central banks are acutely aware of the importance of the financial system and the banks. And that's why we've seen the Federal Reserve, the RBA, acting very, very quickly to provide liquidity into the system. And the Federal Reserve has recently come out with cuts to interest rates and massive amounts of liquidity into the system to keep the financial system running. So they've seen this before in the GFC. They know what to do to keep the system going. But even if the Federal Reserve has done all that, and they did that on the weekend, yet we saw the US market fall 12% on Monday.
That was a beauty, wasn't it?
And that we're used to sort of in the financial crisis, the central bank coming in and providing liquidity. The bad news is good news because we know the central banks are going to pump the system and asset prices are going to go up. That's not what we're dealing with here, because the markets are actually looking at the economy and they're seeing the damage done to the economy and the damage done to corporate earnings and the potential defaults that may occur in the credit markets. So the markets are focused on the economy. Now, central banks are propping up the financial system and the banks, it's now up to governments to pull out the purse and support the economy and jobs and companies. So in this scenario, we're going to be seeing company bailouts. We're going to see fiscal policy being used to support households, to get the economy through what is ultimately a transitionary scenario as we get over this health crisis. So it is a transitionary...
Things are going to get better, aren't they?
They are. They absolutely are. We do have a model, sort of a model in China. China was first in and they're first out. And the Chinese response to this has been excellent, but it's also very unique to China. Now, the fact that China was first in and first out is really, really important for the global economy, because initially when we had fears around this virus, it was, well, China makes all the goods. If China shuts down, where are all the goods going to come from? And that's going to be a supply side shock to the world. And that's what we were worried about. Well, China brought that virus under control and they're getting back to work. Now, that's really important. It's really important because it does take away some of that supply side shock. But it also shows that there is a template for how the rest of the world can handle it. But I think ultimately the rest of the world, particularly the United States, won't handle it as well as China. And we would expect the rest of the world will take longer to get through that other side. But it is ultimately a temporary economic shock that we're facing. Markets at the moment don't understand it. And when they have uncertainty and don't understand it, they overreact and they react very, very quickly. And they will overshoot. But ultimately, when you start to see markets look through that and begin to quantify what the economic impacts are, they will start to look through it.
The market improving, I've heard some investors are saying that we can't possibly even start to look at moving back into the market until at least the next reporting season, because until then we won't have clarity on the actual numbers.
I don't think the market will wait for a reporting season to respond. I think the market will react to other things like reducing infection rates or developments in treatments. I think the market expects results to be really bad. I think the markets are pricing in the worst case scenario. And in actual fact, perversely, you might see companies report results that are horrible, but it might be better than the market expects. So you might see, a rally when these results are reported. I think it's hard to say. And I don't think you want to be trying to rush into the market too quickly. We are in a bear market.
So how should people be responding to this market? I mean, everyone's saying, okay, there's opportunities, but what's the safest risk-free way of approaching that?
Well, firstly, the safest risk-free way of approaching this is don't sell. Obviously, there might be some people out there that are forced to, and hopefully you're not in that position because you don't have debt and you've got a balanced portfolio. So that's probably rule number one, and people will probably be getting that advice, and it's good advice. And in terms of approaching the market, taking a long-term view is important, and picking the bottom is impossible. So I don't think you want to be rushing into this, and I think it will depend really on your outlook in terms of what might transpire over the next month, 3 months or 6 months. And I think it will really depend on ultimately how long this goes on for. Now, we know we've got the model in China where it probably took a month for them to really get through the worst of it and start to get back to work.
Incredible time period, isn't it? Really?
It is. And China's back at about 80% now. So they went into this in January. They're back at about 80%. And we know that from traffic congestion, electricity consumption, pollution levels. The Chinese factories are getting back to work, which is great. Let's hope they don't start to see infection rates take off again. That would be a terrible scenario. But if you look at the time frame that China's managed to do it, if you believe all the numbers, and I think you've always got to put a caveat on numbers out of China, but the reality is they are getting back to work. You look at how they did it, I would expect the rest of the world it will take longer because they've not got the same control and they're not as prepared. So China's probably your best case scenario in terms of a time frame, which you look at about a month or two, a bad quarter. China will probably have a good second quarter. And you might see the rest of the world now have maybe bad 2 quarters at least as you get through it. Back to approaching the market, it's not over, and we're probably now getting into the thick of the storm in terms of seeing the real economic impact. But like I said earlier, when things get really bad and really gloomy, that's probably when the market will actually turn and think, okay, we need to look through this and look forward and start to price in, okay, better times in the third quarter and the fourth quarter of the year. So really, as an approach, it's about trying to pick quality assets in this period of time, knowing that you're buying a good asset for the long term, produces income, a great business that you want to own, and you may not get it for the lowest price. But if you're gradually picking these up through a bear market, you will do well. But it's about looking for that quality as you're trying to navigate a very volatile market. Picking the bottom is impossible, and waiting for the bottom is one of those scenarios that if you wait for the coast to be clear, markets have already taken off. So I think it's sort of a case of gradually averaging into this market.
So you think dollar cost averaging is possibly a good scenario to start into this at the moment?
Oh, look, if you've got assets there that you really like and you're seeing them at a lower price, then averaging into particular investments is absolutely a good way to do it. Looking at particular anomalies in the market, we're seeing listed investment companies with quality underlying assets trading at big discounts, and that's not just equity assets. We're looking at fixed interest assets. So we're seeing big discounts on some of these investments because at the moment it's a propensity to just sell, and there are sellers out there that need to get cash, and they might be just looking to get cash to put into equities. So there are a lot of anomalies out there at the moment where you can pick up assets at a discount. And I know we will look back at this time and see, oh wow, that was a great time to buy something like that. So
I'll just mention at this point that on next week I've got Steve Bull coming in again. He's from ETF Watch, a blog about ETFs, and that's one of the major points that he's made in this current market. There's a lot of listed investment companies that their net asset value can go up and down, and there's a lot of these that are trading at a substantial discount to the net asset value.
Yeah, and so if you can buy a basket of assets at a discount to what they're worth, then that sounds like a great deal to me.
Yep.
You do need to understand what the assets are and how they're valued. So that's very, very important. But the listed investment companies in particular tend to get hit hard in this environment. A lot of them are not as liquid as other investments. And so when there's no buyers out there, you do see a real downside shock.
Okay, so we'll have a bit more in the next episode about listed investment companies. What about, you're talking about getting into single stocks or single kind of assets, but are ETFs worthwhile thinking about at this stage as a way of averaging in?
Yeah, absolutely.
Yeah.
It's probably the easiest way.
It is the easiest way for a lot of people, especially if you don't know or haven't got the research on a particular company that you can actually identify as being a great bargain at the moment.
Yeah, exactly. And you probably want to be sticking to the big ETFs, staying away from the leveraged ones and the synthetic ones. But it's a great way of getting into a market and buying the market generally. And it's a very easy way of averaging into the market.
What's the easiest way of identifying if it's leveraged or synthetic as opposed to a vanilla ETF?
Well, sometimes it'll have leverage written on the tin. So there is a leveraged S&P 500 ETF out there, and basically what that is it uses debt to get the exposure and magnify gains, but also magnify losses. So they're normally labelled as leveraged, and so you know that you're going into a geared or leveraged product.
But for a beginner, obviously you want to just go for your stock standard vanilla ETF.
Well, that's just an easy way of getting into the market, really. And you can look at different ETFs out there that will buy a particular market like the ASX 200 or the S&P 500 or the NASDAQ, or you can look at diversified ETFs that are out there now that will just buy one particular ETF that has a balance of different underlying ETFs there. So you're getting a more balanced approach that might have some international, might have some Australian, may even have some bonds in there. So that's also a great way of effectively buying a diversified portfolio of ETFs. And there are a number of those out there now, which are a great way to get access to the market.
Have you got a final message for listeners, possibly one of optimism?
Well, absolutely. I think it's always important to have perspective. And I think during this period of time, most important is this health and safety of our families, and that we look after each other and take note of the precautions, because the threat is real, but it is also temporary. And that's really important to focus on, that we will look back on this period of heightened stress and fear, and we will get through it, and we will probably get through it better and stronger. Economies do need to go into recession as part of the normal cycle. And while it will hurt and it'll be painful at the time, we will come out.
That's okay. Bear's giving an optimistic. That's Bear the dog.
Yeah, he's agreeing with me. So we will come out with this better, and the recovery will be there, and the recovery will be strong, and it will happen in markets. And I do think we are in a time where it is a great time to be investing in the share market, where the risk reward is now much better than what it was a couple of months ago, I tell you. So that's a reason to be optimistic, even while they're in dark times at the moment.
Rob, thank you very much for coming on and giving us this update.
Pleasure.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
Suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's breakroom easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.